In this video, I will break down the difference between fixed interest rates and floating interest rates. If you find this video confusing, please watch our other lessons on loan and interest rate basics. Interest rates can be thought of as the cost of a loan. These rates can either remain constant over the course of the loan, as with fixed rates, or they can vary. Variable interest rates are also known as floating rates because they float up and down with the market. In the case of fixed interest rate loans, the interest rate is determined by many factors, one of the most important of which is the borrower's creditworthiness. Let's take a quick example. Suppose you had two people who each wanted to borrow money from you. The first is a good friend of yours and you know she's very responsible, so you believe she'll pay you back on time and in full. The second is a stranger. You will likely charge the stranger more to borrow money from you because you're not as confident you'll receive all your money. The borrower's creditworthiness is generally expressed in terms of their credit score, which takes into account factors like repayment history, available assets, and other liabilities that they might already have. Typically, a higher credit score means that the borrower will have to pay less in interest for borrowing the same amount of money as someone with a lower credit score. In the case of fixed interest rate loans, the interest rate that's assigned will remain constant throughout the life of the loan. Floating interest rate loans, on the other hand, are typically tied to what is called an index rate or benchmark rate. Common index rates include LIBOR, prime, and the federal funds rates. These are rates that are determined by major institutions and are published regularly. They apply to very specific circumstances, but usually help to determine the cost of funding for a large financial institution, like your lender. If we take LIBOR as an example, banks in London decide on what rate they would charge each other for a specific loan every few months. As the economy changes, that rate also changes. We call this rate change a reset. A floating rate loan that is tied to one of these rates will reset every time the index rate resets and will include a fixed spread to the index rate. For example, your floating rate loan might have an interest rate of prime plus 2%, meaning that whatever the prime interest rate is, the benchmark rate, your interest rate is 2% higher. The spread on this loan is 2%. The spread is often based on the borrower's creditworthiness, much like with fixed rate loans, but can also encompass various other types of risks and costs. To compare fixed and floating rates, I'll give you another example. Let's say you receive two personal loan options from the bank with relatively equal terms. One loan has a fixed interest rate of 6% and the other has a floating interest rate of LIBOR plus 4%. If LIBOR is currently 0.5%, your total interest rate will be 4.5%. And when you first receive the loan offer, clearly the floating rate is the better option because your interest rate is lower. However, in 6 months, suppose LIBOR resets to 2.5%. So now your interest rate is 6.5%, which is higher than that fixed rate loan, which again will be constant throughout the life of the loan. Of course, you can't actually know what LIBOR will be in the future, just as you can't know what the stock market is going to do in the future. Taking a floating rate loan includes a bit of risk. There's always a chance that your interest rate benchmark will go up or down. You'll have to try to assess this risk before you enter into the loan agreement to make sure you're getting a good deal.